On October 9, 2002, the S&P 500 hit rock bottom after a brutal two-year collapse. The dot-com bubble had burst. Enron had just imploded. Retirement accounts were bleeding. Every financial headline made it sound like the system itself was cracking. A hospital administrator named Carol did something her coworkers called reckless. She took $34,000 she'd been saving for a home renovation and quietly moved it into a broad market index fund. No stock picks, no analyst reports, no timing strategy. Just a calm conviction that America doesn't stay down forever. Her husband thought she'd panicked in the wrong direction. Her brother told her to wait until things settled. She didn't wait. That decision, boring, unsexy, completely available to anyone with a brokerage account, changed her family's financial trajectory permanently. Not because Carol was smarter than everyone else, not because she had access to information nobody else had, because she recognized a moment and she moved. We're living through a different kind of moment right now. Not a crash, not a crisis. Something quieter, slower, and in many ways far more powerful than any market bottom in modern history. A wealth event so large that economists genuinely struggle to find historical comparisons for it. And the vast majority of Americans have no idea it's already underway. Here's the figure that should stop you cold. $105 trillion. That's the estimated value of assets transferring between generations in the United States alone over the next 25 years, based on research from Cerulli Associates and updated wealth projections through 2025. To put that number in human terms, it's roughly 4 times the current U.S. national debt. It exceeds the combined annual economic output of every country on Earth. It represents wealth accumulated across 8 full decades of American growth, now about to cascade downward through families, estates, and financial markets all at once. This isn't a forecast, it's already happening. The baby boomer generation, those born between 1946 and 1964, currently controls an estimated $76 trillion in U.S. household wealth. That's nearly half of everything. The youngest boomers turn 61 this year. The oldest are approaching 80. This generation has entered the phase of life where assets begin to move whether anyone plans for it or not. Here's how the transfer breaks down. An estimated $40 trillion will first pass to surviving spouses, the majority going to widowed women, before eventually flowing to the next generation. This spousal wave is already creating one of the most significant demographic shifts in financial history. Women are on track to control the largest concentration of private wealth in American history within this decade. Generation X, currently in their mid-40s to late 50s, stands to inherit roughly $36 trillion over the next 20 years. For a generation perpetually squeezed between aging parents and college-aged kids, this capital arrives at exactly the right moment to reshape retirement prospects that currently look uncertain for millions of households. Millennials will eventually receive an estimated $40 trillion, much of it arriving during peak earning years, creating a multiplicative effect where inherited capital compounds alongside career income simultaneously. Even Gen Z will begin seeing meaningful transfers as the process accelerates through the 2030s. The scale is genuinely unprecedented. The last remotely comparable wealth creation event was the post-World War II boom, when GI Bill benefits helped returning soldiers buy homes, launch businesses, and build the American middle class from scratch. That event produced the baby boomers. The boomers spent 40 years building their wealth. Now that wealth is transferring, and the cycle is repeating at a scale that dwarfs anything that came before it. Here's the uncomfortable truth most coverage skips right past. The transfer is highly concentrated. Cerulli's research shows that roughly 60% of assets being transferred will come from ultra-high net worth households, a group representing less than 3% of all American families. If your family isn't in that group, a life-changing direct inheritance probably isn't your primary opportunity here. But here's what most people miss entirely. Direct inheritance is not how most new millionaires get created. Look at what happened after 2009. The U.S. had roughly 7.8 millionaire households at the market bottom. By 2024, that number had climbed to nearly 22 million, an increase of 14 million households in 15 years, according to Federal Reserve data and Spectrum Group research. Who were these people? Not hedge fund managers, not founders who sold companies. The overwhelming majority were nurses, teachers, accountants, and mid-level managers who did one simple thing. They stayed invested through chaos and kept contributing when it felt most uncomfortable. A teacher in Colorado who put $450 a month into her 403b starting in 2010 through the European debt crisis, through the 2018 correction, through the pandemic collapse, would have accumulated roughly $240,000 by early 2026 without a single clever decision. That's the baseline, the floor, before wealth transfer tailwinds. The real opportunity in the great wealth transfer isn't the inheritance itself. It's the cascading economic effects of $105 trillion in motion. When that much capital starts moving, broad market indices rise, benefiting everyone already participating. When heirs upgrade homes, real estate appreciates in the markets they move to. When inherited capital funds new businesses, wages and employment rise across the broader economy. Every dollar that moves creates economic friction, and friction creates opportunity for people positioned to capture it. You don't need to be in the 3% to benefit from what the 3% does with their money. Not all assets will benefit equally. Knowing where transferred wealth flows based on how different generations actually invest creates a real edge. Bank of America research consistently shows that investors under 45 have dramatically different portfolio preferences than the generation transferring them wealth. Where boomers concentrated in dividend stocks, municipal bonds, and traditional real estate, millennials and Gen Z skew heavily toward technology infrastructure, clean energy, healthcare innovation, and alternative assets. This isn't a preference survey. It's already showing up in capital flows. AI infrastructure spending in 2025 and 2026 absorbed institutional and retail capital at rates that surprised even the most bullish analysts. Data center build-out, semiconductor demand, and energy grid modernization are capturing early waves of redirected generational capital right now. Real estate tells an equally clear geographic story. Markets attracting younger, higher-earning households, cities with strong technology employment bases, warmer climates, and favorable tax environments are absorbing capital at rates that population-losing markets simply cannot match. Median home prices in high-migration metros have risen over 40% since 2020. Comparable properties in markets losing population have barely moved. Where you own real estate over the next 20 years may matter as much as whether you own it at all. The sectors and geographies that captured boomer wealth over the past 40 years may significantly underperform the sectors and geographies that capture millennial and Gen Z wealth over the next 25. Understanding that shift, even broadly, is an edge most investors aren't using. Here's what almost nobody talks about honestly. Wealth creation events don't feel like wealth creation while they're happening. The 15 years from 2009 to 2024 produced 14 million new American millionaires. But that same period included the European sovereign debt crisis, multiple government shutdowns, a full-scale trade war, a global pandemic that froze the economy for months, and a 2022 bear market that erased nearly 20% of portfolio value in under a year. At every single one of those moments, credible voices argued the expansion was finished. At every single one of those moments, people who fled to cash missed what came next. Research from JP Morgan Asset Management shows that an investor who missed just the 15 best single trading days between 2003 and 2023 saw their total returns cut roughly in half compared to someone who simply stayed invested through every session, the scary ones included. The best days cluster around the worst periods. That's not a coincidence. That's how markets function. The great wealth transfer will follow the same pattern. Recessions will punctuate it. Political cycles will rattle it. International crises will periodically shake confidence, and headlines will regularly declare the transfer stalled, or consumed by debt, or redirected by policy. The underlying force, over $100 trillion seeking productive deployment, doesn't pause for headlines. The people who will look back on this period the same way Carol looks back on 2002 are not the ones who found the perfect entry point. They're the ones who simply refused to exit. The strategy isn't complicated. What makes it hard isn't the complexity, it's the patience. First, maximize tax-advantaged accounts without exception. The 2026 401k contribution limit is $23,500, with a $7,500 catch-up for those 50 and older. IRA limits stand at $7,000. Health savings accounts add $4,300 for individuals. These accounts let wealth compound without annual tax drag, the single most powerful legal wealth-building tool available to ordinary people, and the most consistently underused. Second, own the broad market. Don't try to pick the winning sectors. Don't chase the specific assets that will capture the most transferred capital. Nobody knows which those will be a decade from now. Low-cost index funds ensure participation in aggregate growth regardless of which specific corner of the market runs hottest. Third, think geographically. If you have any flexibility about where you live or where you invest in real estate, research population inflow data deliberately. Capital follows people. People follow opportunity. The divergence between gaining and losing markets will likely widen through the 2040s, and early positioning compounds. Fourth, develop skills that serve capital in motion. Financial planning, estate administration, tax advisory, real estate services, and wealth management will all expand dramatically as $105 trillion moves through the system. Expertise in these areas will see growing demand every year for the next 2 decades, in employment, in consulting, and in business ownership. Fifth, extend your time horizon to match the event. This is a 25-year transfer. Investors who internalize that timeline and stop reacting to quarterly volatility will capture returns that short-term thinkers systematically leave on the table. The math is straightforward. A 38-year-old who invests $600 monthly in diversified index funds for the next 27 years accumulates roughly $820,000 at a conservative 7% return, and over $1.2 million at the historical average of 10%. Increase contributions to $1,000 monthly as income grows, and the 10% scenario produces approximately $2 million. No inheritance required, no extraordinary luck, just consistency across a period when $105 trillion in capital is simultaneously lifting asset prices from underneath. Carol didn't know in 2002 that she was standing at the beginning of a 2-decade wealth creation event. She just decided that fear wasn't a financial strategy. The opportunity today works differently, but the structure is identical. Capital is moving. Markets will be supported. New millionaires will be created by the millions, not through genius, not through access, but through the ordinary discipline of staying positioned while everyone else gets distracted by the noise. The $105 trillion transfer is documented. It's public. It's already in motion. The only question worth asking is whether you're in front of it or watching it pass from the sideline.